Hello, everybody, and thanks for joining us today. My name is Callie Knabley. I am the project manager for ICBA, Independent Banker Magazine, and I have the pleasure of introducing our speakers for today's webinar event, sponsored by Bayside Business Solutions. Our first speaker today is Jay McKinley, Senior Vice President of Operations at Bayside Business Solutions. Jay has over 20 years of progressive experience in software support and operations in various financial lending industries, including banking, factoring, and health and life insurance claims. Prior to joining Bayside, Jay provided independent process re-engineering to financial institutions and served for many years as Vice President and Director of Operations for SunGuard Data Systems, which specializes in enterprise imaging and workflow software systems. Our next speaker is Tim Thornton. He is the Technical Services Analyst at Bayside Business Solutions. He has more than 15 years of experience with asset-based lending, and in his position, Tim works directly with the developmental staff, expanding the current suite of software solutions focused on asset-based lending. Before joining Bayside, Tim served in numerous positions at BBVA Compass, including collateral analyst, field examiner, account executive, and senior technical analyst. And now, with our housekeeping items and introductions complete, Jay, I will turn the presentation over to you.
Great. Thank you, Callie. Hello, everyone, and welcome to our webinar. Today's session, Expand Lending and Reduce Risk, or Tune Up Your B2B Lending, is provided by Bayside Business Solutions, as we said. My name is Jay McKinney, Senior Vice President of Operations here at Bayside, and also with me is Tim Thornton, who will be presenting as well. Today we're going to explore ways to not only expand B2B lending, but to reduce risk and for you to facilitate your compliance at the same time. For those of you who may not be familiar with Bayside, we're a commercial finance solutions company, folks from the industry creating solutions for the industry, and a true focus on commercial lending. We're fortunate to count many household financial institutions among the Bayside family and have many thousands of users spread over more than 8 countries. Our first product was FactorSoft and was designed for accounts receivable financing. We took FactorSoft along with our secured lending product offerings and combined them under one platform and rebranded it as CADENCE. Today, CADENCE is the only product that will allow a lender to offer any type of lending arrangement against any collection of collaterals, all with the appropriate safeguards and controls in a single platform. CADENCE allows lenders to bank a client at the appropriate level of collateralization, and furthermore, you can slide them up and down the scale as appropriately to properly match your risk preferences. By this, I mean that today you can easily take accounts receivable finance customers and onboard them right next to an asset-based lending customer on CADENCE, which are onboarded right next to other C&I business lines you may have. Today, perhaps you don't have a full line of offerings, or if you do, you may have accounts receivable finance customers on one system managed on a platform like ProfitStars or Business Manager, and ABL customers managed on other systems such as Stuckey or Accor. Additionally, many of you may have other higher-end customers that have commercial lines on the core system with very loose collateral associations, if any at all. So today, we're going to hit a broad topic, and we'd like to cover a little bit about the industry trends as they relate to commercial and institutional lending, and then look at some of the drivers for C&I lending and why you need to develop a program if you're not already doing it, and expand programs and offerings if you are already started, and also how you can tighten up your current offerings if you feel you're already in your sweet spot. Next, we'll explore some of the benefits and ways to optimize and properly monitor a portfolio in order to maximize revenue, minimize the associated G&A expenses, to properly monitor exposure, and last but not least, to facilitate compliance. At the end, we should have plenty of time for Q&A. And as said earlier, you can ask questions along the way, and Tim is going to attempt to answer those privately or save repeat questions for the end so that everyone can see the answers to those. Before we continue, please take a moment and you should see a survey question pop up to the right. And if you would take a second and just answer that for us, we would appreciate it. Whether or not you engage in any type of commercial lending today, just a simple yes or no. And if yes, how much of your outstanding loans do you consider to be from C&I? Commercial lending has been growing since the global financial crisis, and what was averaging 9% growth is now clipping along at just over 12%. The trend is continuing as the economy heats back up, and commercial lending is outpacing consumer lending 5-to-1 at this time. Surveys are showing that banks expect commercial lending to account for and represent more than 80% of all of their budgeted loan growth in the near to medium term. Products and services around commercial financing are quickly ramping up. C&I loans outstanding are at an all-time high of $1.7 trillion, and C&I loss rates are at an all-time low of just 0.3%. This is down from an all-time high that was just 2.72% occurring in Q4 of 2009. The largest segment of C&I growth is currently in the secured lending space. Why is this, we ask? The markets you serve are hungry for these lending vehicles. It's likely going to prove necessary to not only gain new customers, to keep those you have. It's a perfect way to increase penetration into these accounts and offer them additional services. As these clients grow, it'll allow you to readily cross-sell other products and services within the institution. The amplification effect of added deposits, fee income, interest income from these segments cannot be overstated. These types of products tend to be resilient and can maintain strong gains and returns regardless of the market conditions. As such, they're always on the ready to help supplement other fee and depository income that may be susceptible to downturns. While this is the fastest growing segment of lending, more than 80% of the budgeted loan growth, as we saw earlier, the market has traditionally been dominated by the largest banks and the independent finance companies. This trend is rapidly changing, even with credit unions now being able to serve their business members in this way. They're getting in on the action as well. Furthermore, the number of banks acquiring factoring and accounts receivable finance portfolios is also on the rise. This is definitely the current trend that we're seeing in our client composition as well, where once we would easily say the majority of our interest came from the largest banks and private finance companies. Today, our typical client is a financial institution looking to offer or expand programs in demand from their commercial customers. If you're not lending, I hope you'll take the time to have a look. Let's pause here for our second question, if we would. If you do offer revolving commercial lines of credit, what type of collateral do you lend against today? There are several options there. Please mark all that apply. So if commercial lending is all the rage, why are only the regionals and the largest of national banks doing it? There's no shortage of reasons, but primarily the folks coming to us have avoided it because they're either focused on real estate or it's just completely outside of their comfort zone, perceived as risky or not economical or worthwhile due to the intense labor and associated cost. Because of the manual, intense ways these deals have traditionally been done, some institutions require a minimum deal size of $3 to $5 million to even make a facility worthwhile. With a proper program and system in place, these barriers should no longer be an obstacle. Proper automation can provide the necessary tools to bring exposure as well as risk and the profitable deal size to a level that's within your comfort zone. Offering such products allows you to remain competitive, and while this type of lending was once considered by some as the lending of last resort, this has not been the case for several years. Many of your clients who are well capitalized and completely healthy have cash needs that occasionally strip their flow. This could be due to meeting seasonal demands or filling large orders or to complete an acquisition, even to expand operations. While these companies may not have cash flows to meet these demands and would not qualify for traditional loans and covenants, they do have adequate assets and excellent performing receivables. By lending all along the spectrum, you can reach more clients and develop longer-term relationships. These loans are usually senior in a company's capital structure. They're typically secured by a majority of its assets and therefore considered safe and attractive. As a local financial institution that still values relation-based services, you have access to a ready-made pool of businesses that need these services. Furthermore, as a financial institution, you have access to lower cost of funds than any independent lender or a finance company. Quite an edge. If you already have an active set of commercial financing solutions for your client base, excellent. You're already meeting the demands of your community, and hopefully you can find ways to serve them even better. Now it's time to really understand the whole of your offerings, not just the total outstanding loan balance, which most people know, but the client needs and drivers, your accurate collateral values, asset quality, your true risk and exposure, and what it's really costing you for the management and compliance of that commercial portfolio. We find it's essential to look at the commercial portfolio from several different views to get a good picture. From a client-centric view, instead of just listing a listing of loans by looking at the overall needs of your client, the proper products and services across the whole of the institution can be sourced and packaged for that client. The more you understand the true needs of each client, the easier this becomes. Next, be sure you can take a customer-centric view for collaterals that are based on receivables. This is absolutely necessary anytime you lend against receivables so that you have a true picture of exposure and concentrations across not only the individual customers or your borrower's clients, but also across industries and even geographic locations. Lastly, be sure to always take a collateral-centric view of your portfolio. This is essential to understanding collateral turn as well as asset quality. It's also essential for compliance and reporting that at any given moment you have a complete picture of the value of the collateral that you're holding as it relates to your outstandings. The design of Cadence is unique to any other portfolio management solution on the market today and provides the real-time through-and-through visibility you need to feel confident in your commercial portfolios. Rather than a simple listing of loans outstanding, which in turn point to client records that are located in the master file, Cadence allows you to focus on the entire relationship of the client. Under the client, you actually have one or more facilities. These facilities can be collateralized by one or more specific collaterals. Examples of more common collaterals are accounts receivable, inventory, and equipment. These discrete collaterals each provide unique controls that are appropriate to the type of collateral being tracked. And furthermore, they can be aware of each other, allowing you interdependencies and auto-settlement. You can establish interdependencies between the balances, limits, and carve-outs relative to the other collaterals, all in real time. We also see here where AR is involved, we have relationships between the account debtors as well as the accounts. The system tracks exposure down to your client-specific customers, so that you can always have a true picture of customer or debtor-centric exposure as well. This is a view of how this looks within the system. I'll quickly share a few screen clips of how these design concepts are actually shown in the CADENCE user interface. This is a clip of a client list where we see a client that does it all manufacturer is the client. And this particular client has 3 different facilities: an ABL facility, a factoring facility, and an over advance or an additional line. If we expand, for example, the ABL facility, now we see the various collaterals that are used to make up this facility. Each has its own distinct controls, values, limits, and of course availabilities. Next, we mentioned taking a customer-centric view or an account debtor-centric view. And this is an example of a screen that allows you to look at exposure by account debtor without regard to client. This particular screen happens to be organized in this view by the concentration, total concentration across the portfolio. Because of this level of control, you're even able to exercise individual credit decisions by account, should that be beneficial to you. Another example is the account debtor screen, in this case, Piggly Wiggly Deli Bakery. And we see that they do business with 2 of our borrowers, ABC Manufacturing and DEF Distribution. We can see their total outstanding, we can see their balance with each client, and we can see those receivables that are potentially aging out. Once you truly understand the entirety of your commercial lines from these different perspectives, it becomes a logical progression to begin to bring automation, control, and monitoring to the operation. Advances in technology are providing ways today to improve communications and contact with borrowers. This can dramatically decrease non-interest expense and bring vast improvements to your quality and level of service. One example of this is what we call tracked AR in CADENCE. Tracked AR is just a name that we use to refer to a functionality that allows you to remain in constant contact with your borrower's collateral value, which in turn gives you more constant visibility into your LTVs. I'm going to turn this over to Tim, who'll give us a bit more detail on the tracked AR concepts in CADENCE. Tim?
Hey, thank you, Jay. The tracked AR functionality offers the lender a couple of good benefits. It offers the lender reduces the administrative costs or burden to the lender, so that the clients, the customers, can report more frequent collateral information to the lender. Because of this, it would reduce the time periods between when the lender can analyze the current loan balance compared to the current collateral value. An example I'm going to show you in a minute shows that there are times when nobody's looking at the amount of space between those 2 items, and you could be over advanced very easily. The tracked AR functionality can also potentially reduce the lender's audit requirements on their clients or their customers, because you're getting more and more, you're getting much more information on a frequent basis quicker, so you could reduce that time period. Instead of going out and seeing your client 4 times a year, you may send somebody out 2 times a year. It also facilitates the Fed reporting, showing that the lender is being responsible with the collateral valuations and how you're doing your due diligence and your ongoing monitoring. Tracked AR also elevates the lending decisions to a higher authority within the financial institution. Some decisions are being made these days in some shops at a much lower level. This takes out that whole analyst level decision making. And as part of tracked AR, we have internal workflows that will increase automation within your financial institution and reduce the potential of human errors. So this is an example of how the traditional method, how most banks and financial institutions are looking at the collateral. This is an example to where the customer reports to the lender on a monthly basis. This is an example for September. As you can see, the loan balance here in blue, it changes day to day, while the collateral balance in red has remained unchanged for these first 10 days in the month of September. Like I said, this is a monthly reporter, so the customer is going to report their updated collateral information on the 10th of each month. This is an example here of what that reporting may look like. It's accounts receivable aging report showing their collateral information. Even though this is just one page of the report, typically what most lenders have been getting historically is something like this. It's a couple hundred pages. Historically, the lender has had a few tools to evaluate that kind of information in the forms of this. And I've used the term tools loosely here. Basically, we're talking about some office supplies of different colored pens and our old trusty calculator here. So the lender historically has taken the reports and their tools at their disposal, and it has taken some time to evaluate that collateral. So now we've moved out 10 days here. The loan balance continues to adjust. The collateral value remains unchanged until we get to that time period where you have taken out, properly analyzed those collateral reports, and you have updated collateral value. And then what happens typically sometimes is that once you've posted it, the collateral increases quite a bit. Now the loan balance here is higher than the collateral value, so you have an over-advanced situation. Typically, at that point, the lender has got to readdress the collateral situation with their client to ask for additional collateral so that the loan balance is covered by some sort of asset. If we look at this from over a period of time, that was just for 1 month of September. So we see 3 months here. We see the same thing happening month over month, period over period. There is always some exposure, potential exposure, and potential risk in the way that operation, the way that this is operating. So the tracked AR functionality can help reduce this because we can get much quicker reporting from our clients. So instead of having a client update the collateral information every 40 days, we can ask for it on a weekly basis, every 7 to 10 days. In this case, the collateral balance has changed. I mean, the loan balance continues to go up and down as it should. The collateral balance changes quicker here on the 7th day. And if we look for the entire month here of September, we say we've changed it 4 different times versus just 1 time in the previous example. And if we expand the same time period as we did previously over 3 months, we see that we've adjusted the collateral numerous times to match the adjustments of the loan balance. And there's never been an opportunity for this loan to be over-advanced. So we have reduced our risk by not over-advancing the line, which is very powerful for the lender standpoint because, again, when that loan is over-advanced, the lender is assuming the risk, and the regulators are not going to be happy if they see that in the portfolio. I'm going to turn it back over to Jay now to discuss monitoring and controlling.
Thank you, Tim. So at this time, let's push our last poll question. For those of you who are engaged in C&I lending, do you have dedicated staff? Simply answer yes or no. So tracked AR is but one example of how Cadence can arm you with tools that bring additional commercial lending products comfortably back into your offerings. The tool set that Cadence provides also replaces the traditional model where our analysts are so busy being clerks that they have no time to analyze anything. Instead, we push the system to perform calculations, absent of human error and emotion, and allow the analyst to truly manage the relationship as they should do. Cadence even helps them in this way by providing real-time heads-up warnings and alerts when conditions approach or exceed your established thresholds. Additionally, the system is designed to prevent any duplication of data entry and speed up the flow of information that you may be receiving now or relying on third parties to provide. This could be credit such as D&B or Experian, along with a host of other vendors that monitor everything from liens to federal tax compliance. I'm having trouble advancing. There we go. The potential downside of the heightened attention to commercial finance products is that everybody's paying attention to commercial finance products, and this does include the feds. So we have to be aware that traditionally they've had very little to say about it, but with this explosive growth, they want to ensure that the rapid growth does not cause lenders to allow underwriting standards to suffer. Some guidance is now beginning to surface to this effect, so we have to watch carefully. But again, Cadence is perfect in that we help you to maintain your underwriting standards, lend responsibly, and be able to report on this so that you have ready proof that that's what's occurring within your organization. With Cadence, you can offer the same products that the mega banks are offering and not lose your customers to the larger regionals and nationals. We've seen that by properly monitoring collateral and the LTVs, you can responsibly free up more availability from the collateral that you're already holding, more money on the street with what you already have access to. In addition, with the distinct collateral controls that Cadence offers, you can provide even more availability from the assets that your borrowers have available to them. Today, there are 13 distinct collateral control structures that Cadence offers. Some of the more popular ones are multiple types of AR, inventory, and equipment. Those are usually the three mainstays. In addition, there's securities, real estate, and even a user-defined control structure that you can use. One additional tool worth mentioning is that Cadence offers a brandable portal for your borrower. This can be used alone or coordinated with your current online offering. This 24/7, 365 presence moves the borrower's interaction to a more efficient contact, while at the same time increasing their perception of your service and availability. This reduces cost while improving the customer's perception of excellent service. Lastly, I just want to touch on how simple it can be to implement Cadence. Cadence can be self-hosted, where it's fully installed and maintained by your IT resources, or it can be delivered as a service. Our software as a service offering gives you anytime access with zero administration for one simple annual fee. Regardless of the delivery method, self-hosted or software as a service, Cadence can work as a standalone system, providing all aspects of your commercial lending operation, or it can integrate with your core system. On the top, we see loan activity being handled by the core, with Cadence managing the collateral, the two systems then sharing information. In the diagram on the bottom, we see Cadence handling all aspects of the commercial lending operation, and as a system of record, would update the core system. I know we've covered quite a lot in a fairly short amount of time, but if nothing else, I hope we've piqued your interest enough to start B2B lending if you're not, evaluate it if you're not, keep your customers, and to tune up and grow a portfolio if you are already doing this. Look at increasing your offerings and understanding what your business clients are truly going to need. Either way, we hope you might consider Bayside as a proven partner to accomplish that. This time, we can move into Q&A if there are any questions.
Yeah, Jay, Jay, we had a question or two from a couple of the folks about our scalability for users. If you want to take a couple minutes and talk about that, how scalable we are.
The system is designed to scale easily from single users to many users. The design of it is SQL-based, and it does allow for infinite scalability. There actually is an engine component, it's multi-tiered, and the engine component can be deployed across multiple systems to provide scalability for any size organization.
And I also had a question that a couple of folks asked when they talked about the client web portal. Was in the examples that we showed, it was English only, but do we have any capabilities for other types of language?
Yes. The system is multi-currency and multilingual, which becomes important in some of the some markets. The client web especially can be deployed with language packs so that you can customize terminologies in addition to offering completely different languages. And those can be selectable by the client. At the login, they can select the languages that are available to them, and the portal will reflect in their language.
And those are only two questions that I couldn't answer or did not get repeat questions of.
Okay. Thank you very much for your time today. We appreciate it.
All right. I think, yep, that's all the questions that I see coming in here. So we'll wrap it up. Many thanks to Jay and to Tim for that great presentation. I certainly learned a lot. And thanks to all of our attendees today who joined us. If we were unable to get to any of your questions, if any of the questions are coming in at this time, we will reach out to you within the next day or two with an answer via email. Also, in the next 2 business days, you will receive a follow-up email with a link to the recording of today's event for your review or to forward it along to any of your colleagues who are unable to attend today's event. So this concludes today's webinar. Please have a wonderful rest of your day.